It's 9 a.m. in Beijing and Hong Kong. Welcome to Bloomberg Markets, China Open. I'm Annabelle Droulers with Yvonne.
Our top stories this morning: Asian investors cautious in the run-up to the last Fed rate decision of the year. Underwhelming U.S. inflation data suggesting policymakers won't be rushing to claim victory anytime soon. Also ahead, China makes industrial policy its top priority next year, despite calls for more aggressive stimulus to juice the economy. Plus, the China-made COMAC C919 makes its first trip outside the mainland as it looks to woo buyers away from Airbus and Boeing. We'll get a little bit more from Danny Lee on the ground there at the Hong Kong airport, of course, on this very interesting trip to the city. But certainly we're going to talk about, the U.S. inflation numbers. We're seeing prices pick up again, right? Reaccelerating. Does it move the needle for the Fed coming up in just a few hours' time? And, of course, we're watching very closely those dots.
Yeah, that's right. We're going to get those new dot projections coming out as well, that key thing, because last time they were signaling around a 50 basis point reduction over the course of next year. Are we going to see a further reduction as well, given in mind that, yes, at the headline level, we still are seeing deflation or inflation numbers sort of ticking up, but broadly, when you put it in perspective, it still is that trend down lower.
Yeah.
And so I don't really think it really shifts that market expectation that cuts are near. It's really just how big they're going to be and why as well the U.S. is going to be doing it.
It doesn't make you trim your bets a little bit, right, about just how aggressive this rate cutting cycle is going to be. That certainly is going to be one thing. We have a little bit more from our MLI strategist, Van Ram. We'll talk you through some of the scenarios he's playing out here on what could be a dovish reaction and what could actually spark a bit more of a hawkish reaction across these markets, given those dots. And then we got to talk about the China discussion, right? We finally got a little bit more of the statement of what came out of this economic work conference. And, I guess people are going to be disappointed.
Well, perhaps, but perhaps it also just meets expectations as well, given that they were probably pretty low coming into it. But industrial policy, that's clearly the big focus for us. That watch really on what's technological innovation, so things like chips, advanced manufacturing sectors as well, but less really on firing up household demand. And so when you take a look at the market session today so far, how we're positioning, you do see that weakness still coming in through to the Chinese session. Sectors that would typically benefit out of some whole-scale stimulus from China, so areas like miners, for instance. You take a look at the Aussie miners today, barely budging off this news. Iron ore as well, that's moving to the downside. The offshore yuan fairly flat right now. Let's change on, though, because markets broadly in the session today, we are pointing higher for the large part here, but the focus really also coming down to the Japanese session, because there's the real outperformance that you can see here, up 0.7%. Worth pointing out as well, we got the results of the Tankan survey in Japan, so it's surprisingly positive numbers coming through. Tells us perhaps there are some better business conditions coming through. What does that mean for fourth quarter GDP? It could as well be a little bit more positive. Some markets there just coming online, you're seeing Taiwan stocks, Singapore fairly flat right now. But if you change on, it really is that focus on the Fed decision coming up, what we can get out of it. Not really seeing much movement in the bond space. Trading volumes as well, they're looking pretty thin so far in the session. And the VIX, to note, that fear gauge tracking around a 4-year low. Yeah, so there's not a whole lot of conviction leading up to this Fed meeting here. So we got through the U.S. inflation numbers. We got to get through this Fed meeting, of course. Jay Powell comments there during the press conference and those dots for us to really see what sort of reaction we're to see this week. But then again, let's get to our top story now. China's top leaders have vowed to make industrial policy their top economic priority next year. And that is a message likely, as we say, to disappoint investors hoping for more consumer-focused stimulus. Joining us now is our Greater China Senior Executive Editor, John Liu, here in Hong Kong. It's good to see you, John. What was a big takeaway from you?
I think the big thing that I took away is it depends on what you think the state of the economy is. Are we in a position where Beijing has enough time and space that they can prioritize things like industrial policy or structural changes into the future? Or if you think the economy is in such a bad state right now that this is a fire that has to be put out, that something big has to be done now, I think you would come away from that readout a bit disappointed. So I think the main takeaway is sort of a mismatch in perception, maybe, is what we have at the present time.
Yeah. Is it going to be something that really gets consumer spending as well, again, given it does seem that focus more on the industrial side?
It feels like Beijing is going to take a relatively conservative approach to whatever it does. No big bazookas being pulled out. There was verbiage in the readout about trying to get people to spend more, increasing incomes, wages for the citizens of China, but there was no specific detail policy on how they were exactly going to do. I think the most clear-cut thing is more spending, fiscal side, maybe a little bit less forceful monetary policy going forward. Yeah.
What about the focus on tech self-reliance? Did you see that being a little bit stronger than any previous years?
I think it's really interesting, especially when you consider that on the second day of this two-day conference, Xi Jinping and lots of his officials are traveling to Vietnam. That I think it just underscores how much of a priority security has become for this administration, and sort of the difference with past administrations in the economy not by far the priority for everybody.
John, great to have you. John Liu there, our Greater China Senior Executive Editor, joining us here in our Hong Kong studios. Let's bring in Ken Shi now, Head of Wealth Management for Greater China at Saxo Markets. Ken, I got to wonder, though, right, that they talk about industrial policy. It doesn't seem like there's a whole lot of urgency out there to really try to come to the rescue of this economy. What's your take?
Well, I think maybe particularly when we look at the month of December, right, liquidity is generally low. Probably not the best time to be changing policy, particularly if we look at the U.S. a couple of years back. But I think, when I look at the overall work conference, I think the result for me was in line with expectations. I think what we've seen, at least in financial markets, particularly in Hong Kong, China markets the past few months, but particularly in the month of December, is clearly investors are more particularly very excited with the positive news that were coming out of mainland China, right? Hang Seng Index is down about 3.9%, and I think CSI is down about 1.9% in this month. But I think the main thing that we kind of touched on earlier was, even though there is a lot of good news, well, how are we actually going to implement a lot of these changes, and can we have further guidance? And naturally, with the third plenum also looking ahead, that being delayed, I think that adds a lot of uncertainty right now into the China market outlook. But I also want to be clear with people that, I think we're cautious, but we're also open-minded. And I think a big part of that is, one, is positioning in China as an allocation, as a region, really has probably been amongst mutual fund managers probably the lowest in a decade. So I think the bar is already set very low. And for those hunting for value in this market, valuations are extremely cheap. I think maybe high single-digit type forward PE. So I think things could actually move in a hurry if we actually do get more solid guidance ahead.
What would it be, though, to get things really moving in a hurry? What's the trigger point?
Yeah, so I think, naturally, if there was some sort of bazooka stimulus, that would be wonderful for everyone, but I don't think that's happening. I think particularly how to stabilize the property market is the big question mark in my mind. I think, obviously, when we look at Country Garden, I think it dodged a bullet yesterday.
Yeah. For how long, though, right?
Exactly. So shares are up about 8% overnight. But when we think about really just a couple weeks ago, when there was news about them getting financial support from the Chinese government, shares popped a lot. But since that peak till now, shares are down almost 30%. So I think that, to me, is, well, can we have some solid guidance in terms of how are we actually going to stabilize this market? And once that's kind of out of the way, I think a lot of things will come a little bit easier.
How do you, what's the strategy around China now then? Can I continue to, maybe shun the property market, and then maybe look at more on the industrial policies, right? Like the high-end manufacturing, the EV sector. Are those sectors still pretty safe from all the macro concerns out there?
Yeah, so I think in terms of themes to play in right now in the market right now, I think for Hong Kong, China, a couple of the high beta names, there's some, I would say, for more short-term, maybe medium-term names that would be on more like innovation, productivity, and maybe also in the green energy space as well. I think those are probably names that we're probably focusing on.
Earlier this week, we had a big China hedge fund saying that this was a once-in-a-20-year opportunity to buy Chinese stocks. Where do you fall on that sort of call?
Yeah, I think there's some legs to what he's saying, in regards to this being a great opportunity, because, very Warren Buffett style, right? When everyone is fearful, we get greedy. And I think, truth be told, the narrative in the market right now is still, I think, extremely negative. And I think for many of us who are keeping a close eye on the China market, I think if things start moving in the positive direction, I think you could get a bit of a pile on in terms of more allocation to this region, for sure.
All right, Ken, you're sticking with us. That's Ken Shi, Head of Wealth Management, Greater China at Saxo Markets. Still ahead, we'll have China's homegrown C919 commercial passenger jet making its first trip outside the mainland and going on display here in Hong Kong. More ahead on its chances of competing with Boeing and Airbus.
And we're carrying down to the open of trade in Shanghai, Shenzhen, and Hong Kong. It is freezing, I believe, in Beijing, I heard. There's a snowstorm coming. School's been canceled as well. But yes, Hong Kong looking a bit gloomy as well, but definitely not as cold. Futures, though, a little bit cold. We're down about 0.4%. This is Bloomberg Markets, China Open. Good morning. Yep. As we count down to that Fed meeting, just a couple hours away, of course, we'll see if that inflation data really moved the needle in any way for the Fed or change their thinking, right? As we start to see consumer prices pick up in November once again, and then reinforcing speculation the Fed will be in no rush to claim victory over inflation just yet. Here's more reaction with some of our guests.
We are seeing inflation slowing, and it's consistent with what the Fed expects.
2%, is going to be the target, and I think they are on track to get there.
The last mile of the inflation journey is often the most difficult.
The Fed tomorrow is probably going to signal, yes, it's done, but don't expect rate cuts anytime soon.
The Fed is probably going to remain on hold at least until the third quarter of next year.
They should push back hard on cuts next year.
They're going to push back again against what the market is pricing.
The probability of a cut in March is almost non-existent. Even June.
Getting a Fed that's cutting in May does feel like a bit of a stretch from where I sit right now.
The Fed probably will be higher for longer, and I'll actually be looking for Powell tomorrow to push back a little bit on where the market is, where it's gotten a little bit ahead of itself. I think this inflation report feeds into that narrative.
Yeah, certainly some different reactions coming through there to that U.S. inflation print, what it means for the Fed. But just recapping some of those numbers, the key takeaway from this is that inflation remains elevated in the U.S. So you've got traders that are really starting to trim their bets now on what easing is going to look like over the course of 2024. Core CPI, you can see they're picking up 0.3% on the month. So it's really just difficult to get price pressures back in line.
And just this, keep in mind, this is what the dots looked like back in September, right? So 2023, they expected one more hike. We may not get it. 2024, they were pricing in about 50 basis points cuts, which is a far cry from the 100 basis points or even more that the market has been pricing in for next year. So are we going to get more of a reality check? And what does this mean? MLI's Venram, our cross-asset strategist, came out with some pretty good scenarios out there, right? So base case is 50 basis points cut. If we stay the same from the September dots, that's the base case. Dovish is we see a little bit more of that revision towards the lower end here, 75 basis point cut. And the hawkish case, if you see a 25 basis point cut, we saw what happened with treasuries after that non-farm payrolls report on Friday, which saw a 12 basis points hike up in when it comes to that 2-year yield. He could easily see the 2-year yield back to 5% if we see something more of a hawkish side from the Fed here.
Yeah, really a lot of focus coming down onto what we get out of those projections later today. Worth noting as well, the Bloomberg economics forecast is for 75 basis points of cuts next year. But let's get the reaction now. Ken Shi still with us, Head of Greater China Wealth Management at Saxo Markets. What are you expecting out of the Fed meeting later today?
Yeah, so I mean, obviously, we're going to dig into Jerome Powell's rhetoric and then further into the dot plots. But I think, when looking at the CPI data overnight, I think at the end of the day, there clearly was quite a lot of narrative about how the market maybe was a bit dampened by the mood, that it wasn't clear enough, that inflation was easing. But I think I want to remind people in the past years that this market is very confident, right? So it will see what it wants to see. And clearly at this point, they are seeing much more of a Goldilocks type scenario. And I think, at Saxo, at least looking into 2024, I think for different reasons, because we're actually anticipating much more of I would say more of a shallow recession. So we actually kind of agree that probably the rate cut will probably be in the 100 basis point range, and maybe even might go even a bit earlier, as early as March. So I think for different reasons, this is why we're saying that. But I think it's one of those things that when I look ahead, one thing that investors should be aware of is clearly inflation will be elevated. But furthermore, while the economy is slowing down, I mean, it's possible we might enter much more of a stagflation type environment. So investors probably should look a little more at defensive sectors. Typically, when we look back at the past 35 years, right, sectors that have outperformed usually are in healthcare, consumer staples, utilities, energy, and naturally, I did not mention big tech. So I think that's something that, a lot of investors should be aware of going forward.
So that's gone too far.
Yeah,
don't expect more gains next year.
Yeah, well, I wouldn't say not more gains, but I think there's almost like a rotation within the market. So obviously a lot of it was concentrated in the Magnificent Seven this year, but next year I feel like a lot of investors really should be looking at a lot of underloved sectors. And
if you're thinking 100 basis points cuts are realistic for next year, what we saw in November with this bond rally, was it justified then in some ways? And what if Jay Powell pushes back against that?
Yeah, I mean, I think, it's not like a straight line type process. And I think Jerome Powell will be pushing back and forth, and there will be a lot of back and forth between market expectations and what's really happening. But I think at the end of the day, if we do see a recession down the road, they won't have much of a choice, to be very honest. And that's the reason behind our base case scenario.
Then when it comes to growth or value, which one do you think is more likely to outperform over the course of next year?
Yeah, I think value really has kind of not been loved for quite some time, and I think maybe going into 2024, particularly within the U.S., a lot of the value names I think will be much more attractive. But when we look outside of the U.S., I think there are actually a lot of interesting things to look at. One thing is I think a lot of the focus has been on the U.S., but really when we look at like European equities from an equal weighted basis, so we're kind of discounting the Magnificent Seven, I think is almost, I would say, equal to the S&P 500 return, about 10.6, 10.7% year to date. So I think that's an interesting area, particularly within defense. I mean, European defense spending, I think, is anticipated to increase by about 10% over the next 3 to 4 years, annually speaking, and we're at an all-time high in terms of spending. Furthermore, I think also the healthcare space. Within Europe, clearly you don't have those AI catalysts within the market, but actually weight loss makes a lot of sense. Everyone loves weight loss, I guess, and Novo Nordisk is a type of name that actually is quite interesting in the European market.
As you say, Europe doesn't have those AI plays. The tech plays, though, I mean, how do you play it in Asia? Is Japan, as you say, really going to be that next leg up?
Yeah, so I think obviously, Japanese markets are up over 20% year to date already, and people are already starting to look at different sectors. I mean, this morning there was news of people looking within the train sector, obviously with the impact of the yen and obviously being more domestic oriented. But I think particularly within the growth sector within Japan, an area that we've been talking to investors about is really within the automation AI space. And I think a couple weeks ago we had NVIDIA actually reporting that they were going to have a partnership with the Japanese government and kind of build factories, semiconductor factories in the south of Japan. I think this is super interesting because actually this kind of plays into what we've been telling people, that actually within the semiconductor space, clearly there is a bit of a, I would say, reallocation in terms of region, or maybe even de-risking kind of away from China and Taiwan, more into potentially regions like Japan, which could actually fill that supply chain gap. And I think there are, one thing I wanted to highlight is a lot of these companies in Japan that are within this space, they have a lot of cash for both like R&D and also investment in the AI automation space. I
think you said about 60%.
Yeah, almost 60%. I think names like Advantest, I think is a name that's probably up about 120% year to date, but still going strong lately. And I think that's something that for clients are thinking about more growth plays within the area probably makes quite a lot of sense.
Ken, great to have you. See you next year. Ken Shi, their head of wealth management, Greater China at Saxo Markets. We're watching Country Garden shares very closely on our reporting here of them possibly avoiding its first default on yuan bonds after most holders of a local note agreed not to demand repayment this week. So maybe a bit of a breather there for the developer. We got plenty more ahead. This is Bloomberg. Well, China is set to show off its homemade Comac passenger jets with a display in Hong Kong on their first trip outside the mainland. The main focus is on the C919, which hopes to compete with Boeing 737 and the Airbus A320. Joining us now is Bloomberg's Asia Transit reporter Danny Lee, live for us at the Hong Kong airport. Danny, good morning. So what's Comac doing here in Hong Kong, and what is it trying to achieve? All right, we believe we just lost Danny here, so we'll try to establish some communication. But certainly this is a kind of a big moment for COMAC, certainly unveiling this the first time outside China. We'll see what the whole implications is. Does it actually break this whole duopoly with Airbus and Boeing?
Really significant as well, because COMAC, as an airline company, has only been able to get one customer airline so far for its C919.
International,
International, yeah. So China Eastern so far the only one. So clearly looking for customers outside of this region. But I think we've got Danny now. So, Danny, tell us more about what COMAC's doing here in Hong Kong, and again, what is it trying to achieve in terms of perhaps finding new customers or making it into an international company?
Yeah, Belle, Yvonne, good morning. So it's a very exciting day here at Hong Kong International Airport. COMAC, the Chinese playmaker, bringing its 2 passenger jets here to the Asian financial hub. And all the attention will be on the C919 jet because it's the first time it's left the mainland. And, you know, it's got a big stage for itself to show what it can do with this C919 jet. And purely because China has built this up to be a rival to Boeing and Airbus, the A320, the 737, and these are 2 jets which are the most profitable for the 2 duopolistic aircraft manufacturers. And so therefore the opportunity for someone like COMAC to make its mark and also just to, you know, grow, especially in one of the world's biggest aviation markets and beyond, it's very much got that stage to try and do that.
Yeah, Danny, what kind of global ambitions does COMAC have here with the C919, and what chances of success does it actually have?
Yeah, this is a really good question because at the moment it's only making a handful of jets. It's only delivered its 3rd jet in exactly a year. So it's not exactly showing itself off to be capable of delivering many jets with the C919. And ultimately it does want to break that duopolistic manufacturing control that Boeing and Airbus has. And, you know, COMAC does have a great opportunity here, but when it's, slow in producing, it is obviously, not a great case for, it's not a great case when it's trying to sell to airlines, but it has said that it wants to deliver or make 150 aircraft a year within 5 years, and it's already got a backlog of 1,200 orders from mostly Chinese airlines and lessors alike. It's still yet to find a foreign buyer for the jet, and so its chances of success outside of China are slim. But today it will meet and also this week other airlines, Cathay Pacific, etc. And so we also spoke to the CEOs of the airlines, and they're not interested in necessarily buying this jet yet.
You're watching Bloomberg Markets, China Open, counting down to the start of trading here for equities in Hong Kong and mainland China. And at the start of the day, we're really focusing very much on what sort of investor reaction we can expect to the Central Economic Work Conference wrapping up, and that focus really coming into industrial policies, not so much on big picture or big demand stimulus. Yeah, was there anything new that came out of this statement? Some would say, no surprises here, in line with expectations, and really you're not seeing that stimulus blitz, according to Bloomberg Economics, for next year. So maybe you are already seeing a little bit of disappointment across these markets. And really, we'll see how this all plays out, right, as we count down to the Fed. So certainly that's still why investors are a bit cautious, especially after those U.S. inflation numbers did show a bit of reacceleration. Does it still keep that whole soft landing scenario here? But again, the dots very much in focus. Here's your open at Shanghai and Hong Kong here today. And you are seeing some marginal declines across the board, 0.5% down. We're just teetering around that 16,300 level for your Hang Seng. HS Tech is seeing that drag here down about 1% or more. And we're watching a slight bid, not really, when it comes to renminbi and CGBs, though. But you're watching Shanghai crude, that plunge in oil prices overnight on this robust and these concerns about robust supplies. It's really following what we saw when it comes to WTI and Brent markets as well. So we're down about 5%. And we're watching very closely sector by sector how this plays out. So, we saw a little bit of mixed picture when it comes to some of these industrial metals, just given the focus when it comes to industrial policy.
Where you're seeing disappointment is maybe the consumption side of things, because people were expecting maybe more measures to stimulate demand in some ways, and we didn't quite get it. And we're watching the property market very closely. There you go. CSI 300 real estate, we're down some 2% right now. There was a big surge yesterday on Country Garden and some of these big developers on maybe the prospects of them avoiding this default on the yuan bonds. So that certainly is petering out here today. But we're watching very closely, right? So all these kind of innovative sectors of the market that they're talking about when it comes to industrial policy. So everything from BYD, XPeng, EVs, high-end manufacturing, not seeing a positive reaction. XPeng's down 3.5%. Xiaomi, so consumer electronics. CICC was talking about maybe consumption could still be an outperformer, because they did talk a little bit about subsidies to households as well. Not seeing a clear reaction really with the likes of Xiaomi and higher smart home. And we're watching the developers very closely. We saw Country Garden was flying yesterday. Here we are. We're slightly lower here, 2.5%. Evergrande and Siffy Holdings were some of the big moves that we saw yesterday. Seems like we're fading a little bit of that move here right now. But Wanda Film resuming trade after a few days of suspension here. There's been some news from Wanda, the founder Wang Jianlin, ceding control of the mall unit, also selling that film unit stake to the likes of PAG and investors here. So they're going to be holding 60% of that Wanda unit in this new deal.
Yeah, big question of what it means for its IPO timeline. But let's get back to the big focus, though, for markets in the session today, really how investors are reacting to the guidelines and the policy announcements that came out of the Central Economic Work Conference in China yesterday. Let's bring in our guest now, Xiaolin Chen, head of international at Crane Shares. What's your reaction to these policies? Is this the kind of things and enough of what investors are hoping to see? Because the markets so far seem a little bit disappointed.
Thank you, Annabelle, for having me on your program. Clearly, this is a very important event. Investors are looking for guidance on policies and directions the policymaker are going to make the policy in the new year time. We see reconfirmation of pro-growth stance from the Chinese policymaker as one. Second, high-level senior officials attended the meeting, namely President Xi Jinping himself attended the meeting, shows how important they treated this meeting is and how important they treat economic recovery is a very important item on their agenda for next year. And in terms of the statement they announced, obviously, most important to me of everything is they are acknowledging the challenge, the difficulty ahead for the country to face through growing the economy again. That is very important. They recognize the challenge, they recognize the difficulties, and the policy to follow. To me, Chinese economy is not a liquidity issue. Okay, investors is looking for another boost, another stimulus. I wasn't. We were looking for a reconfirmation and acknowledgement, and they did that for us. Liquidity, is it sufficient? It was 1 trillion announced, say, bond issuance to help with infrastructure, so on and so forth. Another 1 trillion from PBOC, remember, a few weeks ago to help real estate developers, so on and so forth. To me, it's less liquidity needed. It's acknowledging. They have done that for us, at least.
Acknowledging is talk, certainly, Xiaolin, but can this market recover if there's no sort of hint even of large-scale stimulus?
Great question, Yvonne. We have to see effective systems and channels to allow such introduced liquidity thus far to really get to the end of the corporate hands, to allow them to get hold of these cheap borrowing cost liquidities, to allow them to grow their economy, to expand their spending if needed, and hiring as a result. So if households get a decent job, decent income to expect, consumption will pick up. It's a result of that. So seeing liquidities, namely watch out for credit pickup in the coming months, is crucial. As a result, you will see sales, so on and so forth, to pick up from there. So liquidity flow down to the system. It's absolutely crucial.
Where are we at then so far in the recovery? Do you think we've seen the worst so far for China's economy, or is there going to be further weakness to come from here?
I think we're halfway through. If you ask me, I think we're halfway through. The reason I say that is, first, you need to absolutely to know that we need help for the corporates to recover. We have done that. Second, you need to see the stage 2, which is the policymaker acknowledging the needed support, the needed stimulus, which you have witnessed many PBOC cuts on rates this year. The announced fiscal spending, the announced of the helping on the troubled sector of real estate. That's all done. The third key point for the government to deliver is where are you going to grow the economy? Where? Is it going to be the green economy? Is that the driver for the long-term sustainable growth that they aim to achieve for China for this next decade? I heard a lot of modernization, industrialization, all of that. Put those in action. Where will be the where will be the sector industry will benefit from such policy? I think in the coming January, February, March, the few more events that are coming, those events, I highly hope they will give clear guidance, which is the next stage of where to grow, where the corporate can focus their growing to spending, to participate the rebound, and the country can rebound from there.
Yeah, and maybe you could tell us where flows are going. I mean, we've seen fast money exit this market as almost as quickly as they entered. We're talking about 4 straight months of outflows when it comes to northbound flows now. I mean, where are flows going to be headed next year then?
I think relatively speaking, from bottom up, the offshore listed Chinese companies are looking alarmingly cheap. Obviously, investors can argue for a reason. But to us, those stocks are really hugely get a sell-off or caused the sell-off by macro factors of policies, of regulations, so on, so you name a few. That is settling down per se from macro factors perspective. Then we're going to see a pickup from investors recognizing the fundamentals of the growth. If liquidity is sufficient, corporate can focus on growth. They should pick up in revenue, which they have already shown signs of recovery in revenue of the last earning release for those names. We'll see some of the pickup, and we anticipate some investors to pick up the arbitrage in valuation from offshore listed companies of the Chinese companies that can benefit from a stimulus policy. But the valuation is relatively cheaper compared to onshore stocks.
There are a lot of long-term structural issues, though, in the Chinese economy. So what do you think is going to be top of mind going into next year? Is it going to be the developers? Is it going to be the banks? Is it going to be local government debt loads? Is there something else that could appear instead?
Couple of things. I still think real estate developer will still face some period of consolidation. It's not finished. We have been saying that. That's one. And I think sectors will benefit a lot is innovation, technology, namely energy transitioning. China has been spending $500 billion every year over the last 5, if not 10 years in energy transitioning, in renewable energy, in hydrogen energy, in solar panels, all those areas. I think they're going to continue that trend. So sectors like such will continue to lead in a global marketplace. We expect that to continue. Smart EV space for Chinese car makers continue to internationalize their business, to open up more, show house internationally, will continue to benefit by promoting the brands, promoting the technology or smart technology they've been offering from Chinese car makers' perspective. And domestically, they would have to help the household to have more cash to spend, and eventually will help the domestic consumption to recover from there.
All right, Xiaolin, we'll leave it there. Thank you, Xiaolin Chen, there, head of international at Crane Shares, talking about what the prospects are going to be for 2024. We got to focus on the property sector, as Xiaolin just mentioned. Sources are telling Bloomberg that Country Garden is likely to avoid its first default on renminbi bonds after most holders of a local note agreed not to demand repayment this week. Now, for more, let's bring in our bond and loan reporter Loretta Chen, joining us here. Right, tell us about the onshore bond in question and what sort of credit protection did Country Garden give to creditors?
Yeah, so this bond was actually in the process, was sold in the process of a government help program last year, and they to help investors gain confidence in buying the bond, they added this credit default swap on the bond. So today is the day when investors theoretically can demand an early redemption of the bond. But days ago, we have heard from our sources that regulator from Shenzhen Exchange has been in talks with these bondholders, trying to persuade them not to ask for early redemption, because Country Garden, which faces a liquidity crunch, obviously doesn't have the money to pay back.
But what was it that persuaded investors then to forgo the option of payment?
Yeah, good question. I think it's a very heavily top-down process from the Shenzhen regulator. I mean, you have to face the question of, what would be the consequences of a potential onshore default for Country Garden, and then that consequences could be really catastrophic for China's property sector. So I think they're trying everything they can to avoid that scenario.
How significant, how good news is it that they can actually avoid default, though?
Yeah, well, I mean, it's good news in the sense that onshore investors wouldn't have to suffer what we've seen in the dollar bond market. Yeah. But again, to offshore foreign investors, it's yet another sign that they are not being prioritized in those bond payment process, and that you can see clearly that onshore authorities are trying everything they can to help the developers, at least to maintain that prospect that the business is still going on as usual.
All right, Loretta Chen, thanks very much for your time this morning. That was Bloomberg's bond and loan reporter, Loretta, in Hong Kong. We'll have plenty more ahead. This is Bloomberg.
Some top stories we're following for you today. Argentina has devalued its currency, the peso, by 54%, and it's part of the new administration's first dose of shock therapy for the country's troubled economy. The IMF welcomed the decision, saying it will help stabilize the economy and set the basis for more sustainable private sector-led growth. Chinese President Xi Jinping has pledged to prioritize diplomacy with Vietnam. State media says he told Vietnam's Communist Party chief that China hopes for a deeper partnership between the two nations. They signed 37 agreements, including on a cross-border railway and joint maritime patrols, and a 3-year plan to boost trade. Xi's visit comes as Vietnam forges closer ties with the U.S. and its allies. China's financial policymakers are in Hong Kong this week, seeking to bolster the city's status as a hub for investments, deals, and talent. Sources tell us that the Ministry of Finance is meeting with bankers today. Among those invited are HSBC, Standard Chartered, and Bank of China. Discussions will center on how to enhance Hong Kong's position as an international finance center while strengthening ties with the mainland.
Well, the United Nations General Assembly has voted overwhelmingly to demand a ceasefire in Gaza. That underscores a sharp shift in sentiment over Israel's war against Hamas. For more, let's bring in Bloomberg's Bruce Einhorn. Bruce, in this sort of scenario, I think it looks like Israel and perhaps even the U.S. are looking a lot more isolated now.
Yes, that General Assembly vote took place shortly after a vote in the Security Council where the United States has a veto. The U.S. was the only country to vote no, vetoed that resolution. The U.K. abstained, I believe, and then everyone else voted yes. The U.S., of course, doesn't have a veto in the General Assembly, and so the resolution passed overwhelmingly. President Biden did make some comments. Up until now, President Biden has seemed to be very careful about making sure that there's no daylight between the U.S. and Israel. He's been very forthright in his support for Israel and its fight with Hamas, and that's come at a political cost to him, especially with young people in the Democratic Party, polls showing that they're not happy with the position that the president has taken. The president made some comments at a fundraiser in which he did start to have some more critical comments about Israel's policy. He referred to sometimes indiscriminate bombing in Gaza. He also talked about the very conservative government in Israel and said that the Israeli position about not moving forward with having the Palestinian Authority taking over some role in Gaza, that's not okay with the U.S.
So it sounds like the U.S. stance is changing a little bit when it comes to Israel. What do you think we can see moving forward in this relationship? What can the U.S. still support when it comes to this war now?
We should caution all this to say that while the president did have some mild criticism of Israel, it was pretty mild. He did make sure to say in these comments at the fundraiser that Prime Minister Netanyahu is a good friend of his. President Biden has a long history of strong support for Israel. So the U.S. is not going to be doing anything at the moment, it seems, to push very hard. But there are signs that the pressure is increasing. Jake Sullivan, National Security Advisor, is on his way to the region. Lloyd Austin, the Defense Secretary, is also on his way to the region. Lloyd Austin had issued some comments recently referring to his own experience in the war in Iraq, fighting in urban areas, and the importance of protecting civilians because of the danger not only to civilians themselves but also to the mission, because that could just lead to a backlash. So we're going to be having increased U.S. presence by U.S. officials in the coming days. As far as what comes next with the war, unknown. President Biden did comment on reports that Israel is flooding some of the tunnels in Hamas with seawater, and the president said that he had heard that there were no hostages in those tunnels at the time. Beyond that, we don't know more about what's happening there.
That sort of focus on Ukraine, though, from the US, or rather from Israel from the US, really does shift attention away from what's happening in Ukraine and the Russian invasion, of course, going into a third year. It does really appear that Ukraine is sort of also facing a chillier reception from the US.
And well, President Zelensky is in Washington now, concluding a two-day visit that has included meetings not just with the president and people in the White House, but also with congressional leaders. One of the goals is trying to lobby Republicans to approve the Biden administration's proposed package of aid, $60 billion plus in aid. That's gotten stalled in Congress over issues related to border security, the southern border. Those negotiations are underway. We hear that the negotiations are not going well, that there may not be a passage of Ukrainian aid before the end of the year. However, deadlines do seem to focus the mind, and so it's possible that we may get a breakthrough, but I wouldn't count on it at the moment. So President Zelensky was hoping that he could sort of move that along. There is a good chance that if it doesn't happen now, that means that there won't be any aid to Ukraine until after the holidays.
All right, Bruce, thank you. Bruce Einhorn there with an update when it comes to Israel as well as Ukraine here. We got plenty more ahead. This is Bloomberg.
We're about 20 minutes into the session so far for mainland equities and Hong Kong as well, but the focus very much in the session so far and what sort of market reaction we're seeing to China's Central Economic Work Conference, because the real takeaway from this has been that the focus is on industrial policy. That's the key focus for next year. Things like self-reliance, the focus on advanced manufacturing, there's some of the key takeaways. The reaction so far, it's actually very muted in markets, so it tells you either investors are a little bit disappointed or this sort of guidance has just met expectations, and so we're not really seeing too much movement. And those miners as well, you can see here, they are dropping in the session. Iron ore a little bit weaker, that contract as well. The focus really not on sort of firing up household demand. It's a little bit more on things like chips, maybe EVs. So it's not your typical areas or sectors perhaps that could have benefited in the past from whole-scale infrastructure spending.
Yeah, you're still seeing a bit of disappointment, right, across some of these industrial miners as well. I mean, you take a look at Jiaojing mining, that's down some 3%. Perhaps it's the gold price, but certainly there's a bit of, people didn't think of it. There was anything new that really came out of this economic work conference to suggest that we're going to see more stimulus next year. So perhaps that's why you're seeing markets are slightly down on the path of that. There's an interesting read out there when it comes to Netflix, right? If you don't want to put your eye on these markets right now.
Yeah.
Maybe there's something you can watch on Netflix. And for the first time, they've come out with, every viewer data for every title on its platform. And it's interesting. The list that came out was quite interesting. I was pretty surprised by some of these.
Yeah, I mean, it's been the most detailed ever for any streaming service. But you put it in context as well, why they're doing this now. I mean, we've just had a months-long fight between Hollywood, labor unions, major studios. And so, yes, you got a little bit of compensation off the back of that. But take a look at that trust, that erosion, that trust deficit. People really want to understand how much viewers are watching these, when they're watching it, for how long. And then that can help them really not only build the programs, but they also want on the compensation, perhaps, in turn.
Hopefully this helps in this whole the creative community and how we can move on from, after these strikes, right, earlier in the part of the last few months. It's interesting, though. I got to list out the ones. Number 1, The Night Agent Season 1, Ginny and Georgia Season 2, The Glory, this is the K-drama Season 1, Wednesday Season 1, and Queen Charlotte of Bridgerton Story.
What I want to know,
top 5.
How many of those have you seen? Full disclosure.
None.
Not a single one.
I've seen Ginny and Georgia Season 1, but I didn't get to Season 2, so I didn't know it was such a hit. But yeah, I mean, Wednesday obviously was a hit. I heard a lot about The Glory. Just haven't gone to it. Maybe during my Christmas plans.
I don't know. I think I'm watching too much Bloomberg because I have not.
You need to take a break.
I have not seen a single one of these at all.
All right. But there were some surprises. But I heard Night Agent was pretty good, too. But yes, biggest hits right there from Netflix. Coming up, some big hits coming up, too, when it comes to interviews. We got Citigroup Global Markets, Joanna Chua, telling us why she thinks it's still too early to expect a rate cut from the Fed. Plus, we got Fitch Ratings sharing their outlook, I should say, about China's EV market as they expect competition to intensify in 2024. Of course, you talk about price wars, a lot of competition up there when it comes to not just Europe, but also within domestic China as well. This is Bloomberg.